So our next question comes from Clarissa B. Clarissa says, thank you so much for the Rich Habits podcast. It's given me the right mindset to start my financial journey as a 22-year-old recent college grad. So here's the deal. I recently had to buy a new car after I graduated back in May because my old car was always breaking down. I traded my old car in and paid $27,000 for it. I put $7,000 down and took out a $20,000 loan from a credit union at 6% interest. My new car is a used 2021 Tesla, although I would have liked to buy a beater car, pay for it in cash, all the fun stuff that you guys say. I just couldn't justify buying another gas guzzler that would break down again because I live in a city with a ton of hills and it's just, I've got scar tissue because of it. As a current college graduate with an electrical engineering degree, I take home $2,000 every paycheck after taxes and 401k contributions. With every paycheck, I've been paying the car off with $1,000 toward the principal. The car now has a $15,000 balance on it, but I feel like I'm falling behind investing in my Roth, my brokerage, and saving for travel. I try to invest about $100 a week into each of these accounts, but I'm worried it's not enough and I'm just living off of the scraps. Do you think I should continue doing this and stick it out for 7 more months until it's paid off? Or should I allocate that $1,000 a paycheck to investing now? Thank you guys for all you do. Clarissa. Robert, I'll let you kick this one off.
Yeah, you break these down really well, but I think no matter what, the Roth always comes first. $583 a month, you max it out instead of paying down a car that has, a decent interest rate at 6.15%. So in my opinion, I would max out the Roth first. I would make sure that I have that emergency fund, and then anything that's left, if you feel like paying down the car, go for it. But always remember, a vehicle is a depreciating asset. So when you're over here putting all this money to get it paid off because you want to get it paid down so quickly, just remember it's depreciating right along with those payments. So that's why we would rather see, at least in my opinion, the Roth IRA gets maxed out first and foremost, because that's compounding over time, tax-free into retirement, and the growth is going to be fantastic through the Roth IRA. That's my take on it.
I'm right there with you, Robert. Here's what our friend Clarissa could consider doing. Max out the Roth IRA every month at that $583. Congrats. You now have essentially $1,400 left over if you wanted to go pay down that car quicker. So now you go from paying your car off in 7 months at again, this is like decently high interest rate, 6, 7-ish. You're starting to get to that, high single digit range. So instead of paying it off in 7 months, you pay it off in 11 months, right? So that you now have this, call it $1,400 a month to pay off $15,000. And now you have no car payment and also nothing for this money to go to. Now the all $2,000 a month, not just $583, but all $2,000 is getting invested into your bridge account, the Roth, the HSA. Maybe you're doing some 401k action. You've got autonomy over there, right? Now you are in your 20s, call it 23, 24, investing $2,000 a month. How quickly do you think you're going to become a millionaire investing $24,000 a year? The answer is very quickly, right? So I would do that. I would get the Roth rocking and rolling first and foremost, make sure that's above everything else, especially at your age, because $1 invested turns into 70 in retirement. So again, that $583 a month turns into $41,000. Every month you max out your Roth IRA at your age is another $41,000 in retirement. So yes, you should be doing that. But on the flip side, I hear you want to pay the car off. I get that. Do the Roth. Bare minimum. Once the car's paid off, double down on your investing, maybe double down on, just saving and investing. Maybe you want to buy a house soon. Who knows what your goals are, but that's sort of the framework I would use in the process of building wealth at your age and your situation.